I'm the Chief Financial Strategist at Whole Financial. Welcome to the inaugural podcast here. I'm here with Matt. I'll let him introduce himself.
My name is Matt. I do a little bit of stock trading. I am not incredibly financially literate, but I learn a lot from my
He sells himself a little bit short.
I do real estate full time. I flip houses, wholesale, do all different kinds of things. But as far as stock market goes, I trade occasionally, but I get a lot of my tips and tricks from this guy right here, and he shows me a lot. So for the purposes of this podcast, I'm going to be somewhat of the voice of a retail trader.
Yeah, and kind of our objective for you guys is to you can get a lot of sources, whether it be just individual in the real estate world. You can get a lot of sources on the bond world, if anybody's familiar with that. You can get sources on the equity world, but you don't really have a lot of places that will tie them and bring them all together. So kind of what we're hoping here is that you guys have a 30-minute weekend review and a look forward on how those markets are intertwined. And then also if you guys are looking for anything specific as far as what actionable advice, if you will, going forward in those kind of markets. I mean, this guy is amazing. He sells himself short. He did an amazing job. He's really, really versed in the real estate world. Kind of like what he said in regards to equity world. I definitely have asked him multiple questions when it comes to real estate. I made a couple horrendous investments and kind of decided I was done with it. And he kind of showed me another side of things. So that's kind of the objective. And I know we won't do this every single time, but as the inaugural, that's kind of what we're hoping that you guys will receive from our time. So. So just from my perspective, I don't know what you kind of were looking at last week in the real estate world, but for me, obviously last week, everything was dominated by the Fed.
Yeah, it was like Fed week. That's all I saw when I was on YouTube. And so as the typical retail, sorry, I want to say real estate just because everything I do is real estate. The typical retail trader, you go on YouTube and you see all these different channels, and all I saw was like Fed this, Fed that, just Fed.
Yeah. So personal conjecture here, just take it for what you will. I think we made a lot of mistakes, especially for 2018 and 2021, particularly the 2018 and 2020 time period. We basically kicked the can down the road, to use the old saying. You can see a chart back, if you go back to 2018, the end, the Fed started buying tens of billions of dollars of bonds a day to basically prevent us going through recession. Well, the kick side of that is you're basically creating inflationary pressures that eventually are going to grow and present themselves, and that's where we find ourselves today. Basically, I mean, and you guys know, I mean, so for example, if you're a business, you are starting off, real estate's a very capital intensive business. You need lots of money. You have to find sourcing one way or another, right? One of the options is private lenders, another option is a bank, another option, which I'm actually looking at doing for the company I work with, is you can actually issue bonds, which are collateralized, basically collateralized IOU. They can be collateralized, in your case, by the real estate you buy. They can be collateralized by equipment, machinery, etc. Or you can issue uncollateralized. And what the Fed was doing is, government also issues these too, they're called treasury bonds. The Fed was going into the market and to provide stability and to provide inflationary pressures, they were actually acting as an independent buyer.
What kind of bonds are they buying? I guess it was
they do. It was a mix.
Okay.
So, but also that's kind of one of the
sectors all over the place buying bonds, and just to basically stabilize the market.
Yeah, and that's not a conventional tool that they use. Interest rates, traditionally speaking, are kind of like their most conventional tool as far as to stimulate or destimulate kind of like the lending market. So that getting back to what happened this week, you obviously had a massive CPI print. If you look, the way we measure inflation has actually changed. So, you know, if you want to compare apples to apples, if you want to measure the way we calculate inflation now, and when you want to use that standard, you can go back to the 80s when it was registering, you know, 13% inflation or whatever. And if you use that same metric to calculate what we had in the 80s, we're actually a lot closer to those levels of inflation now.
Oh, really?
Yeah.
I did not know that. Because I always see, like, apologize for the interjection,
Yeah,
I always see that when people are talking about inflation, everybody's kind of saying, oh, but it's not as bad as back in the 70s or 80s when everything got Paul Volckered, right?
Yeah.
And to hear that, that's kind of eye-opening for me. That's
Yeah,
crazy. to
yeah,
think,
and-
you know?
And so basically the Fed, the interest rate is one of the ways to basically slow down lending. I mean, I don't know. Have you guys seen, as far as the real estate market goes? I mean, I know there's a whole supply-demand dynamic, so you necessarily won't see prices directly change one way or another because you have that dynamic as well. But as far as the volume of transactions, have you guys started to see that slow a little bit?
So I could give a quick 2-second summary on what I'm seeing happening in real estate right now. So as you know, interest rates are going up. As interest rates go up, I mean, we're up 3% from what we were like 6 months ago, something crazy.
Yeah.
And for every 1% that interest rates go up, housing prices go down 10%. So relatively speaking, we have like a 30% drop in housing prices, or a pressure, I should say. You haven't seen prices drop 30%, but there's a 30% downward pressure from that 3% rise in interest rates. However, on the flip side of that, you also have 30% more buyers than there are sellers. So you have this kind of an offsetting supply-demand issue, which is counteracting what interest rates are doing, which is why we're seeing things just level off right now. That's why you see these interest rates going up and prices not cooling down, is because of that alternate pressure of the whole supply-demand issue. And something really interesting that I found that I wasn't too aware of, it was actually a really kind of a crazy dynamic, was it's not necessarily so much that buying is cooling off because there are more buyers. It's more so that the demographic of buyers is changing, which blew my mind, where 9 months ago, 12 months ago, there were a ton of different buyers and the market was, as you know, just going straight up, right?
Yeah, universally, like every segment.
Everywhere. It's been going nuts. And now in real estate, it's plateauing, but you start to see that there's houses on the market that are sitting for a while and some that are flying off the shelves. And I didn't know what was causing that disparity. And then I saw one key metric that really kind of explained it all, which was the average buyer 9 months ago had a credit score of 670. Take a wild guess what the average buyer is right now.
The basis of this guess would be because of just the lesser liquidity and ability to pay the loan. It's gone from, you said it was what, 670?
670.
I'd probably say like 635.
So funny enough, it's 770.
Really?
It's gone the opposite direction, which is why you're seeing houses sit, because the ones that are sitting are the ones that are basically have a little bit of work to be done, but there's a more affluent buyer that doesn't care about the rising interest rates and is still buying. But that's why certain houses are actually flying off the shelves, just because it's the really nice luxury homes, the ones that are getting flipped with 100.
So you're saying like a bifurcation of the market between the haves and the have-nots.
Exactly, 100%.
Gotcha.
And so that's actually, it's kind of like a weird little disparity. But anywho, so inflation rates, going back to the original point, inflation rates, as far as they've been affecting real estate, has been this kind of weird dynamic where myself as a flipper, I've had to, instead of doing a flip where like, oh, we're not going to do the kitchen because we're not going to see the ROI return, that's completely changed course, right? Now we have to do everything perfectly and amazingly, because you're appealing to a more affluent buyer that'll just, you know what? I don't really like those countertops. Pass by on this one.
So bringing that full circle, and we can add this out if you don't want to disclose on this one, but I know you guys had a house over by a railroad that you finished a few months ago, put on the market. And for those of you kind of watching, it's in a more affluent area of the Orlando. So Orlando, Florida obviously has been a very, very hot housing market. The housing location is kind of close to a nicer neighborhood, if you will, in the Winter Park-ish area. And then you guys put it to list on the market.
It was listed at 650. It was listed too high, but the main reason that we were having trouble with selling that one is because it's like a famous YouTuber by the name of Meet Kevin. He would actually consider this a but house. Yeah, it's a good house, but you know, X, Y, and Z. And on this house, directly in front, the front door neighbor where that lot would be is actually industrial, right?
Okay.
So there is a warehouse in front with a business. So you can put a luxury home, but there's this condition that the more affluent buyer is going to say, not
So
great.
it's kind of falling into that like that middle range where you're having a bifurcation and it
Exactly.
doesn't fall into one
Less
or
affluent
the
people
other.
can't afford the interest rates right
Okay.
now, and they don't want to pay that. And the more affluent buyer is just going
They
to pass
want
it by.
that $3 million penthouse.
Exactly.
Gotcha.
Yep.
Well, hey, listen, I learned something new there. I actually would have thought, just gut reaction would have thought it would have had the kind of opposite effect on, the credit scores and stuff like that. But it sounds
blew my
like
mind.
that's not.
I didn't expect it at all. No, I really saw something weird happening in the real estate market. I didn't understand it at all until I saw that stat, and it all made sense. But yeah, no, crazy enough.
Gotcha.
Yeah, interest rates. So I guess going back, we kind of went off on a tangent there. Going back to, so you were giving us more or less a history on how we got to where we're at right now,
Yeah,
right? So
yeah.
bonds, government was buying bonds. Fed can control what's going on more or less with stimulation, destimulation based on rates,
Yeah.
and give it right back to you. So what's going back in our history?
So as far as how that applies to the equity markets, I mean that's kind of where we are, and like the Fed. I've been saying this for a while. The Fed is kind of now in a box, so between like a rock and a hard place, where you have to choose the lesser of two evils, right? So like by raising the rates, first of all, they've been way below like what they consider normal, like your industry average, if you will, for a long time. So where we're going now is just basically getting us to, there's speculation of what they're going to do next, but we're probably going to be around 2%. And that's kind of like your base, your normal, nothing crazy is on the upside, nothing crazy on the downside, kind of your status quo interest rate, if you will. So that's kind of where we're heading to. We're not even really heading into anything that is going to be kind of a hindrance, if you will, because if you also look on what they consider real rates, you take the inflation rate, you subtract the actual interest rate, that's your real rate. So because inflation is so high, we actually still have negative real rates, which is actually still a stimulant to the economy. So the Fed feels kind of comfortable where they're at now, where, the lesser of two evils is you have two situations, they do nothing, and the value basically of the dollar becomes irrelevant, which is kind of what you saw people kind of freaking out about over the last year and a half. And, if you go back into history, the consequences of that are 9 times out of 10 war. So that's one option. Or the other option is that they do something and that they hope that it slows things enough to where we're not in this massive inflationary environment, but it doesn't slow things too extreme where we had in 2008, where it's just a freezing of the financial systems, if you will.
Makes sense.
So
some potential
that's what everyone's debating right
grave
now.
consequences.
Yeah. So that's kind of what that's why the market was looking to the Fed, and not just as much as their interest rate hiking, as kind of like their commentary on the call. And I actually listened to the call live as it was kind of happening, especially the second half, while I was doing some other things for work. And the Fed's very well aware of it, because you had people asking about, as opposed to buying bonds, they're now going to start selling some of these. And there's people concerned as far as like, are you guys going to accelerate it beyond the level you're already discussing? Because then that kind of...
Because then if you flood it...
Yeah, exactly. If you're going too far too fast, interest rates, even with them raising them, are still on a real basis, taking into account inflation, are still negative. So people were more concerned about that. And, he kind of calmed the markets by basically just stating like, hey, we're aware of the consequences.
That's in this last
in the
week.
last meeting.
Okay.
And so it kind of stabilized things, and you kind of saw, the bond markets kind of calm down a little bit. Spreads came down a little bit.
Yeah, so that more or less explains why the market tanked on, what was it, like Wednesday?
Yeah. So going into Wednesday, what happened was everybody, the last meeting, the Fed chairman was basically asked directly like, hey, are you guys planning on doing a 75? Is this on the table? And
A 75-point hike. Okay.
Yeah. So at the time, the chairman was saying basically, that's not currently in discussion. So this isn't. So they didn't explicitly say there's 0% chance we're going to do it. But the terms that they used, the market kind of interpreted it as rightfully or wrongly like this, kind of off the table. So everybody was expecting 50. Then you had massive inflation print. You had, lots of fears as far as oil and all this kind of, inflationary pressures, like I was mentioning earlier.
And so when it comes to oil, real quick, just because again,
Yeah.
speaking from the retail side, oil, when prices of oil go up, it boosts the price of everything else.
Yeah.
So it's kind of like a twofold on inflation, right?
Yeah.
Where okay.
But oil is like housing, where you still have supply and demand dynamics at play. So it's not just a straight monetary issue.
I gotcha.
And I mean, Exxon, all these guys are obviously incentivized to produce more oil, which is they've been doing, because they're making money hand over fist right now. But so the expectation going into this week was 50. There's a news article that
50
basis points, yeah.
Okay.
And then there's a news article that came out on Monday that they were discussing 75, and that was an option, which the market had basically kind of taken off the table. And that's why Friday you saw a massive sell-off when the print came out as far as the actual inflationary pressures and the numbers and all that. And then Monday when this article came out that, hey, we didn't have it on the table, but this is such an extreme number, we can't just turn a blind eye to it.
So you're talking about Friday as in the 10th.
Yeah.
Okay, gotcha, that sell-off on Friday into Monday, then Monday it all kind of recouped.
No, it kept selling because you had
that's right.
basically
Tuesday,
the reaction to
Tuesday was like a little relief bounce.
You kind of had a little bit of choppiness, but basically from Friday of last week, and I don't have great podcasting, but I don't have the internet connection, so I don't have the exact numbers. Basically from the little rally we had, from those highs to where we were at the lows kind of like on Wednesday or Thursday, you had like a 10% pullback in like 4 days.
Okay.
So, you had a little bit of choppiness, a little bit of like green sprinkled in, but it was basically just, this is the reality. Like that number came out and people were expecting it to be high, but there was a lot of kind of chatter that maybe the number would be less bad, if you will. And so that's kind of what the expectations were starting to swirl around those rumors, right? And then obviously you had the number come out and it wasn't. And then you had the report come out that was leaked to the Wall Street Journal on Monday that basically in response to the extreme inflationary circumstances we're facing, 75 was back on the table, and that's kind of when everyone was like reacting to that news. And then when the news came out, it was kind of like a pause, if you will.
Yeah. Was there a little bit of a relief bounce on, was it Thursday or yesterday?
Yeah, it depends on the sectors.
Okay.
You had the Dow was down a little bit, and it was more granular. It wasn't.
I gotcha. Okay.
It wasn't correlated to a total asset sell-off or whatever.
Got it. Okay, so all in all, I guess this past week is.
Yeah, so that was all about the Fed last week as far as the equity markets are concerned.
Okay.
Yeah. So.
Cool.
And then so looking ahead.
Cool,
I mean, it depends. Like I said, the alternative is if the Fed does nothing. The alternative is everything that we transact, that we use to transact, basically the medium that we use to transact. If that is perceived to not have any value, basically the end result would be like a war. Some would probably argue, I personally don't see it any other way. You can go back to Rome, you go back to like Constantinople, you go back to like historically speaking, we have thousands of years of, the most recent case being Germany prior to World War II. They had such massive inflationary pressures that people were basically taking the money that they had, that they were getting paid for the work they were doing, going home and burning it in the fireplace to stay warm that was kind of the environment that led to, the war. These people had nothing. Horrible situation. They were desperate. Hitler came along, promised them something better, and they were willing to take it. And they were willing to ignore kind of like the social issues that came along with it. So at the end of the day, it might not be pleasant, but if what you are transacting in on every single thing, and it's not just, you go to a store, and you buy something, you use $1, or your debit card electronically use $1. The entire market system, as far as equities go, as far as the bond markets go, these are massive financial systems, and if what you're basing them off of doesn't, we get shut down over here. Somebody didn't like us.
All right, there we go.
But what you're basing off of them now is you can't value that. You don't have a rational way to value it. It creates massive problems. So
Just
that's kind of what the Fed is looking at. Like we have to do something, and so that was the entire topic of the week. But looking forward, as far as like being on the real estate side, I know you're mostly in residential as far as real estate goes. Kind of over the next week or so, are you guys looking for anything specifically as far as like how that might affect you guys, or is it kind of?
So it's a little bit different for me because the way I see things is going to be very different from someone in on the retail side who's normal family working W-2 jobs, and they don't know whether they should sell their home because they can get top dollar, but then they're going to pay top dollar for something. Just a quick 2-second thing where if you're in that position and you're considering selling but you don't really know what to do, I would highly suggest that you look for wholesalers if you don't mind doing work or hiring and somebody to renovate homes for you, only because that's the only way it really makes sense. If you own a home and you want to capture that massive amount of equity without dumping it all into another home that's also incredibly inflated, it's usually finding a home that's off market. And so myself wholesaling homes, it doesn't really affect me so much because I find homes that are off market that need a lot of work. And so because I'm buying homes 50 to 60 cents on the dollar, 70 cents on the dollar, whatever that is, it always makes sense no matter what the market. So my next week outlook in real estate is probably going to be the same for the levels because real estate is so much slower.
Yeah, and it's more stable. It's not
right. Like if something's going down, I know it's going to go down for a while. If something's going up, I know it's going to go for a while, right? So it's a little bit different for me. But
you're also backed by a tangible asset. Like everyone needs a place to live.
Yeah, and so usually what happens too is like, people think like, oh, you can't afford an investment property right now. Well, if you find something off market, wholesale, put some renovations into it, right? So you buy it for, let's say it's just for ease of numbers, $100,000 house. You buy it for $60,000, you need $20,000 work, right? You have $20,000 in equity. The thing is, one, you have that equity, but also, as most of you probably know, the rental market is absolutely bonkers right now, right? And usually the rule of thumb in renting is that as long as it can rent for 1% of what the home is worth, it's a really good rental property. You will cash flow on that property, right? Cash flow being defined as the money you're keeping in your pocket after you pay the mortgage, interest. Mortgage is in principal and interest, taxes, insurance, and something put away for like operational expenses. If your AC blows, you replace the roof after so many years, whatever that is. The money left over is your cash flow. You will cash flow if you can meet that 1% rule. And right now, properties are like, finding something that meets 1% is like incredibly easy. So we literally just wholesale the property over in Avon Park, which is kind of in the middle of nowhere, Central Florida, like south of Lakeland. And it's going to be at something absolutely crazy, like 2.5% is what the investor's making. They bought the property from us for $80,000. And then we managed renovations for $10,000 worth of renovations. And the reason too this makes sense is it has a garage apartment. So we got a mobile home and a garage apartment. So it's basically 2 separate units. And we're putting that 10,000, like 9,000 of it into that garage apartment. And we're property managing it for the person who bought it from us, and we're renting it out right now. We already have the one side rented out. Just renting out that one side and not the garage, it's renting for $1,300. And he's all in right now. Renovations paying us and like buying
all in costs.
He's all in at $90,000. He's renting one side out for $1,300.
Okay.
So you're at
you're well above 1% at that point.
Yeah, he's at like 1.4, something like that, right? Now you add the garage and you get another $600 or whatever that is. Like now you're over 2% a month on your money.
Yeah.
In the real estate world, that's great, right?
Yeah.
2% a month on your money, and like stocks may not be so great, but at least you have a bunch of other things in real estate as well.
Yeah,
like
it's
the appreciation.
Again, it's a different risk and a different
right.
Yeah.
You have the equity pay down that they're paying the principal on your loan. You have the depreciation taxes that you get to claim every year. You have these different things, and it's also not a daily job, right? The guy has us property managing, so he doesn't care. He's making 2% of his money. He's happy. So he's gonna make 24% a year. He's ecstatic.
Yeah. Yeah. No, I did. And again, it probably comes from things in the real, like you said, things in the real estate market act, because it is backed by a physical asset that basically is essential. They act a lot more methodically.
Yeah. So I guess long story short, just to wrap that up, that's my weekly, like for real estate wise at least, it's just find more off market stuff, right? It really doesn't change. It's whether the market's going up or the market's going down, because we're always buying. under what it's worth at the time. We
Yeah.
just have to be knowledgeable on what's the house
Right.
worth at that time. That's
And
all.
you guys
it
got
really
to
matters.
manage the projects correctly.
Right,
basically.
exactly. So
Yeah.
as long as we are up to date on that and we understand what's kind of going on with interest rates and whatnot, it's a lot less complicated than people think. It's just, marketing to get those properties right. So.
Yeah, and then just for me, looking forward, and it's going to be kind of off the beaten path, actually, probably for what you hear from a lot of different individuals. Maybe it'd be on your traditional news outlets or YouTube or wherever you find your source of information. I actually Monday, I believe it's Monday again. Don't hold me to this. I believe Germany actually comes out with their inflation reading, and the reason I'm looking at that is they are a massive chunk of the EU zone economy. And so just kind of wrapping up where I'm looking forward going to next week, it would be essentially that reading, because the Eurozone is one of the largest economies in the world, and obviously you have a lot of different pressures, especially Eastern and Central Europe with everything going on, obviously with Russia, the whole oil and gas situation. I kind of want to see what they're looking at, if they come in way above expectations or if they're in line. The ECB, which is basically what the Fed does in America, ECB does for Europe, they kind of stated that they are going to also take measures to address kind of the massive stimulants that have been dumped into their markets back in 2020 when COVID was around and all that. So that's kind of one thing I'm looking at going forward. And we also have, on Thursday, we have a big report as far as oil numbers goes, as far as the reserves coming out of Oklahoma. This kind of directly affects WTI and WTI pricing.
What's the
And West Texas crude, so
Okay.
short. So you have a number coming out Thursday as far as basically storage rates and all of that.
of oil?
Yeah, and
Okay.
so kind of really looking towards that, because obviously oil last week we actually saw a little bit of an improvement as far as a build in inventory. Basically inventories were higher than expected, I should say, as far as oil goes, which is actually why you saw oil sell off last week. I know it was kind of a sub headline with everything going on with the Fed, but I think next week we kind of have a period where there's not a lot of massive news going. We're not in earnings season. The Fed isn't going to have some minutes and stuff like that, but there's no massive market moving event compared to what there was last week. So those are kind of the two things I'm looking going forward, and that kind of brings me to the next part of the kind of what we're going to end the program with: is sell the rip or buy the dip. So a lot of people have been talking about oil equities as far as is now the time to get into them. I know I've heard numbers of oil 150, oil 200. I've heard numbers from a couple of guys I listen to, as well as oil 65. So you have a very wide dispersion of projections. And I think part of that is because you have so many non-traditional factors influencing where the market is right now. And whether you think those factors are going to continue or they're going to die off is kind of why you have such a massive gap. So guest honors, shooting over to you.
What do I think is going to happen?
Yeah, just like as far as, I know you still have a little bit of exposure to equities, kind of do. And we have some of the major market caps, Exxon and stuff like that. They pulled back as much as 10% in the last few days.
So this is kind of based on what I think the S&P is going to do, not oil.
Well, you
Alright,
also
guess
have,
everything?
you have because oil, like you said, oil goes in everything. So
I think we're going to have, if I had to take a guess, I would say we're going to have a short-term rally and a long-term dump on S&P overall. I think oil, we're going to have the opposite. I think we're going to have a short-term dump and a long-term rally.
So at these levels, you'd basically be selling the rips right now in the oil market.
Right now, I would sell the rips in the oil, and I would buy back in at some kind of dip. And that's only because it's just and this is like, for me, it's more gut feeling than anything, because I don't do all the reading, all the different things. And so for me, just gut feeling, oil's been on a rampage. I don't see it slowing at all, just based on the different market conditions, everything that's going on right now. And I don't know. I just usually feel like when something rips for that long,
Yeah.
like it's usually just not sustainable in the short term. So
But especially with oil, I mean, with the market you're in, I mean, you guys know concrete, everything as far as construction goes,
Yeah.
concrete. It's all very,
yeah,
machinery, energy intensive.
right. Interesting stat. We had the lowest, actually, month-over-month readings on new construction starts this past
Yeah, I
month.
saw that last week.
14% down.
Yeah.
And so some people are, it's funny, some people are looking at that as though it's indicative of a housing crash. I
It's
strongly disagree.
it's glass half full, glass half empty on that one.
I actually think it's the opposite. I actually think it's like,
You don't have enough supply, and this is only going to make it worse.
exactly. I really think it's going to continue to make it worse, because right now what's happening is some people think that new construction starts are slowing down only because they have so much to work on, and there's so much inventory is going to flood the market. It's actually not true. There's not enough permits pulled right now to satiate the demand that's out there. So if it's slowing down, it just means
Which would actually be a boon for oil demand as well, because more activity, more construction. stuff like that.
right.
Yeah. So the reason I brought this up, because obviously, like I said, I've been in the news a lot, and actually this is one where I think, individually speaking, if you guys have an outsized stake relative to the overall economy, oil right now is the S&P is roughly 5%. If you go back to 2008, it was roughly 10%. So as far as like an overall factor of basically the pool of the economy, they have a much smaller influence now than they did 10 years ago, right? Their market caps are a lot smaller. A lot of that is because these guys lost tens of billions of dollars for a very long time because they mismanaged what they were doing, which is probably the reason why gas and oil was artificially cheap. So getting back to that, I personally would, if you have an outsized position, meaning more than 5% of your portfolio is dedicated to oil or oil service or something like that, now is definitely what I would be trimming profits, because for me, it's kind of one of those show me, where 2008, it was at 10%, it dropped all the way down to 1%. Every single cycle you have, these oil companies have shown that time and time again, they don't have capital discipline. And what I mean by that is they don't reward shareholders when times are good. They just go out and drill. And so then when things turn south, they have an excess supply.
And you wouldn't exactly recommend shorting oil because timing is like incredibly difficult, right?
That, and also it's extremely volatile. I mean, again, if you're watching this and if you had any sort of crypto exposure over the last few months, you could understand what I mean by volatility. It makes massive moves to the upside and massive moves to the downside. The commodities markets in general are like that because oil trades on the last barrel of oil sold. So whatever it costs to buy that last barrel of oil is what every single barrel sells for. So when that demand for that last barrel of oil falls, or when the supply for the last barrel of oil increases, that's why you kind of see, in part, why you see these exaggerated moves. And I also just think that you've had such an outperformance relative to the markets. Markets have been down this year. Obviously, it's January 1. Oil and service sectors, you've had most equities anywhere from 65 to 100% return year to date. And that is by far an extreme outsized performance. And I'm kind of in the boat until these companies can prove that they can manage their capital better and actually reward shareholders and investors. Especially right now with kind of the returns you've seen. If you have an outsized basically position in oil or oil equities, I would be taking profits on those. Not necessarily saying to get rid of it, because like I said, like you mentioned earlier as well, oil goes into everything. So these companies I don't think are going away. I don't think they're going to go broke. Even worst case scenario, in 2008 we had a massive recession, but Exxon's still here. So I'm not saying to completely dump all of them, but I would definitely, from a management perspective, I'd be looking at basically paring down the percent that you have exposed to that. So I would definitely be selling the rips in this kind of environment right now.
Okay. Anything else besides it? Like, I guess, for the wider market?
I mean, the wider market right now, we're gonna have a dead week kind of right now, like I said. And
so you're just watching?
Yeah, it's gonna take time for, I think, everything to digest things. So as far as the SPY goes, the SP 500, I think you're in a massive oversold territory. You know, you had the VIX hit 35, which is volatility index, which a lot of people use kind of like a fear index. And I just think especially there's a lot of companies that have massive stockpiles of cash based on the last few years. I mean, Apple, they produce their stuff for $5 and they sell it to you for $8, and they keep the cash every single year, and they got so much cash that they could literally continue to buy back their own equity stakes and not really be affected even in a downturn. So that kind of will kind of be, in my opinion, kind of the buoy for the next few weeks until we kind of look into some more major data points that are going to occur beyond next week.